Welcome to Iron Financial, the only place where we forge stronger portfolios by cutting through market weakness. I'm your lead analyst, and with me, as always, is our resident market skeptic.
Good to be here. I see we're diving into the fifth Third Bancorp earnings report. Looks like a messy one.
Messy is an understatement. They just closed their massive merger with Comerica, and the first earnings report is a Rorschach test for investors. Depending on how you look at it, it's either a financial fortress under construction or a house of cards waiting to collapse. Our job today is to figure out which it is. Well, let's start with the number that's spooking everyone and sending shockwaves across trading desks. 15 cents. That's the GAAP earnings per share. To call it a miss is being generous. This is a complete and utter collapse. We're talking about a company that was earning over $1 per share just last quarter. If you're an investor just glancing at the headlines, you're not seeing construction. You're seeing a five-alarm fire. It looks like the engine has completely seized up and everyone is heading for the exits. Hold on, not so fast. That's the smoke, not the fire. You're looking at the chaos of the construction site and missing the skyscraper being built. You have to look under the hood. When you strip out all the one-time merger costs, the advisory fees, the severance packages, the system integration charges, all the upfront pain of bolting on a massive new operation, you get a completely different number. You get 83 cents per share. That's not just a beat. That's a decisive victory over Wall Street expectations. This isn't an engine stalling, it's a brand new high-performance engine being installed, and we're just hearing the first rumble. So which is it? That's the multi-billion-dollar question. Is this 15-cent number the legitimate, unavoidable cost of building a new financial superpower? Or are these so-called adjustments that get you to 83 cents just a convenient way to hide some serious structural flaws? Is Fifth Third a solid investment being forged in the fire of a merger? Or are we looking at a cleverly disguised house of cards? This is where the smart money is made or lost, and we are going to get to the bottom of it. All right, let's get to it. Here's our game plan for today. First, we're going to dissect the headline shock and get to the bottom of these two conflicting numbers. Then, we'll pull back the curtain on the merger itself and analyze the true cost of this integration. After that, we're going deep into the engine room to see if this new combined machine is as powerful as management claims. We'll stress test every bolt and weld for any sign of weakness. And finally, we'll give you our verdict. Is this a ground floor opportunity or a trap for the unsuspecting? Let's lay the groundwork. The entire investment thesis for Fifth Third right now, whether you're a bull or a bear, hinges on a single crucial point: the enormous chasm between the official, by-the-book, GAAP earnings and the adjusted numbers that management is pushing. Understanding this gap, what's in it, and whether you believe it's temporary or permanent is the key to unlocking the true value or lack thereof of this company. An 82% difference. Let's be clear, that's not a rounding error. That's a canyon. The company is telling us to simply ignore 68 cents per share in costs. That's a massive ask. They're saying, trust us, this 68 cents is just noise from the merger. But what is that noise exactly? It's real money spent on bankers, lawyers, and severance. It's like a car salesman telling you a car gets 50 miles to the gallon, but you can't count the gas it takes to actually start the engine and drive off the lot. How can you fundamentally trust a number that needs that much cosmetic surgery to look good? And you're right to be skeptical. Look at this chart. The GAAP net income looks like a train wreck. We're talking about a drop from almost $700 million in the fourth quarter, represented by that middle bar, down to just $128 million in the first quarter, that tiny bar on the right. The market sees a chart like this and panics. It looks like the company hit a brick wall at full speed. But here's the crucial thing. This isn't a mystery. This isn't a sign of core rot. All of this chaos, all of this red ink, can be traced back to a single, identifiable, and temporary source. That source being the Comerica acquisition, a nearly $13 billion all-stock deal. And let's not downplay what that means. This isn't just buying a new piece of equipment or opening a new office. This is a full-on corporate marriage between two massive, complex institutions. You're trying to merge two different cultures, two different legacy IT systems, which is a notorious graveyard for corporate ambitions, and two entirely different armies of employees. History is littered with mergers of this scale that looked great on paper but ended in disaster. This is where corporate synergy goes to die. It's a high-wire act with no safety net, and they're betting the entire company on it. And that's the key context. This is a massive undertaking, and we're looking at the very beginning of it. As the timeline shows, the deal just closed on February 1st. So this Q1 report is a snapshot of the absolute messiest part of the process. You have what's called a mismatch quarter. You've got all the heavy upfront closing costs hitting the books at once. The lawyers, the bankers, the integration consultants, the day one severance packages. But you've only got 2 months of Comerica's actual revenue generation contributing to the top line. It's like you're paying for the entire construction of a skyscraper on day one, but you've only rented out the first 2 floors. The costs are temporary, the asset is permanent. So now, let's get to the good stuff. It's time to look past the smoke and mirrors of the headline numbers, past the construction dust, and see what's really going on in the engine room. The bull case for this stock isn't built on hope or fancy accounting. It's built on a bedrock of solid, core operational metrics that are already screaming buy. This is where we separate the hype from the reality and see the true power of this new combined entity. This is the iron being forged. And listen to the CEO, Tim Spence. He isn't mincing words. He's not trying to hide behind a bunch of accounting tricks. He's pointing directly to the numbers that really matter for a bank's long-term health and survival: net interest margin and tangible book value. He's telling the market that the short-term pain is a small price to pay for the long-term gain that is already materializing. Of course he is. That's his job. Talk is cheap, especially from the C-suite. Let's see if the hard numbers actually back up his optimism. This is what I'm talking about. Look at this chart. This is net interest income, the lifeblood of any bank. It's the raw profit from their core business of taking deposits and making loans. And notice the dramatic spike in that Q1 2026 bar on the far right. It's a 34% increase year over year, a staggering 26% increase from just last quarter. This isn't incremental growth, this is a rocket ship. This is the combined power of the two banks creating a revenue engine that is far greater than the sum of its parts. This is the high-octane fuel that bulls believe will power the stock to new highs. And it gets better. They're not just bringing in more money, they're making that money more efficiently. The net interest margin, or NIM, is the profit margin they make on their entire loan book. A 17 basis point expansion in a single quarter is massive in the banking world. This demonstrates that by combining their balance sheet with Comerica's, they've created a more profitable asset base. They've created a lean, mean, profit-making machine, and this is just the beginning of them realizing those synergies. This isn't a promise, it's a fact reflected in the quarter's results. And the strength goes deeper. Tangible book value, the hard physical worth of the company per share, grew 15%. Credit quality is rock solid, with charge-offs at a 2-year low. And their capital buffer, that CET1 ratio you see at 10%, is a measure of their ability to withstand a crisis. It remains very strong even after a massive acquisition. Okay, I'll give you that. The tangible book value is up, credit quality looks solid, and their capital position is strong. These are important metrics. But you can't just cherry-pick the good news and ignore the risks. You can have the most powerful engine in the world, but if the chassis is made of papier-mâché, you're still going to have a very bad day. These numbers look good now, but are they built to last through the turbulence of this integration? All right, enough of the bull case. It's time to put this company under the microscope and look for the cracks in the foundation. The bull case sounds great in a PowerPoint presentation, but the real world is a messy, complicated place, especially when you're talking about a $13 billion merger. We need to stress test this new structure and see if it's really as tough as they claim. It's time to play devil's advocate and kick the tires hard. Let's start right here with the efficiency ratio. This is a fancy way of asking, how much does it cost you to make a dollar? And the reported answer is a horrifying 84.5%. That means for every dollar of revenue they generate, they're spending almost 85 cents on operations. That's not a business, that's a charity. Now, management wants you to ignore that and look at the adjusted number of 61.9%, but that's a massive 22-point difference. How much of that gap is real, temporary merger cost, and how much of it is just accounting voodoo designed to make things look better than they are? That gap represents enormous execution risk. Now, every public company has to include a forward-looking statements disclaimer in their reports. It's the legal equivalent of the fine print that your mileage may vary. It's essentially a list of all the things that could go wrong. And frankly, most investors just skip right over it. But in a situation this complex, with a company in this much transition, you ignore it at your own peril. And if you bother to read that fine print, you'll see that they're practically screaming at you to be careful. They list 46 different risks. And buried in that legal boilerplate are the two big ones we're talking about today. Look at risk number 35, difficulties in integrating acquisitions. And then there's risk number 46, the mic drop, the risk of an inability to realize the anticipated benefits of the merger. They are telling you in black and white that this whole grand plan could blow up in their face. The bear case isn't something we made up. It's written right there in their own SEC filings. All right, let's put it all on the table. We've heard both sides of the story. We've heard the bull case, a new, more powerful financial institution rising from the ashes of a messy but strategic merger with a core engine that's already firing on all cylinders. And we've heard the bear case, a potential house of cards held together by accounting tricks, wishful thinking, and a mountain of execution risk. Now it's time to make a decision. On the one hand, the numbers that form the iron core of this bank don't lie. That NII growth and the NIM expansion you see on the left are off the charts. The credit quality is top-notch and the tangible book value is growing. This is a company with a demonstrably solid foundation. But on the other hand, you cannot ignore the risks on the right. The headline GAAP number is a disaster that will scare off plenty of investors. They are relying heavily on adjustments to make their story work, and as we just saw, this is a massive, complex merger, and they've already told you it could all go wrong. So here's my take. This is not a company in trouble, this is a company in transition. The ugly headline numbers are not a sign of failure, but rather the price of construction. Fifth Third is paying the heavy, upfront cost to build a bigger, more profitable institution for the future. The underlying data, the core NII and NIM metrics, tell me that the project is on track and the new foundation is strong. The noise you're hearing is just the sound of construction, not collapse. And I'm with you on that, but this is the very definition of a show-me story. The blueprint is beautiful, but I want to see the finished building before I move in. The next few quarters are going to be absolutely critical. We need to see them close that gap between adjusted and GAAP earnings. We need to see if management can smoothly execute this massive integration without any bolts coming loose. The risk here isn't the plan, it's the execution. A sloppy execution could leave this company in a permanent state of costly construction. So here's the bottom line for your portfolio. Do you get in on the ground floor of this new financial fortress, betting on the blueprint and the core engine while accepting the near-term mess? Or do you wait on the sidelines for the grand opening, demanding more proof that the structure can handle the stress? That's the question you have to answer. Thanks for watching Iron Financial. Don't forget to like and subscribe for more in-depth analysis that cuts through the market noise.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.